I studied 100 real investor portfolios, and here are the 7 biggest mistakes that people make. And honestly, I've made most of them myself. Of course, none of this is financial advice, but you'll be able to take some of this and apply it to your own investment portfolio. And if you're new here, my name's Ryan. I'm in my late 20s. I make content on investing, and over the last 8 years, I've grown my own investment portfolio to over £100,000. And I'll be sprinkling a little bit of that into these next 7 tips. Let's get into number 1. Not understanding where money was actually being invested. Joe is a good example of this. Sorry, Joe. This is his portfolio, and you can see just by working it out mathematically, he's very overweight US stocks. The US stock market makes up roughly 65% of the total global stock market, but he has a lot more exposure to US stocks in his portfolio. There's nothing wrong if this is intentional, but most people, from my experience, don't realize it. They invest into a range of stocks and funds and have no idea what their money is actually being invested into. Diversification. What this translates to is too many ETFs. This might sound counterintuitive, but more funds doesn't mean more diversification. Not only does investing into more funds confuse and overcomplicate your approach, but it can actually make you less diversified. Why? Because more of your money is in specific stocks and countries. Look at this portfolio from Bash, 14 different funds that he's invested into. Many of these highlighted here track the same companies essentially. So not only are a lot of these funds invested into the same companies, but do you really need them all? Keep it simple and use less funds. You'll then understand your investing approach better and are more likely to actually stick to it for the long term. If you want to set up your own investment portfolio properly and then grow it for the long term, join the waitlist for my next investing course. It'll be the first link in the description. Home bias. This is very common for us in the UK. We often see the FTSE 100 plastered all over the news and in newspapers. But, and you may not know this, but the UK only makes up about 4% of the total global stock market. So by only having UK funds or UK specific stocks, you're missing out on 96% plus of the total global stock market. And this would have been quite detrimental in recent decades. Look at the performance of the FTSE 100 versus the S&P 500 and a global index. The easiest way to eliminate all home bias is just by using one low-cost global index fund or ETF that is market cap weighted around the world. This means the fund will invest 4% into UK stocks, roughly, because the UK makes up 4% of the total global stock market capitalization. Slightly different, but another bias being all in on the S&P 500. USA. These on screen are a few popular low-cost S&P 500 ETFs for us UK investors. Now, I know the US stock market, and in particular the S&P 500, has performed amazingly well for years, even decades now. And I know many of the investing goats, Warren Buffett included, say all you need is the S&P 500 as your investment. And listen, I'm not going to start beefing with Warren. If he wants to come on the channel, you're welcome anytime. I'll fly down to Omaha. Business expense, you know, so might as well. But the best country constantly changes, and it is rare that one country is the best performer for multiple decades in a row. I mean, just look at Japan in the 80s and 90s. It was the largest stock market. Now it makes up a much, much smaller share of the total global stock market. So if you betted on just Japan back then, you'd have relatively lost out quite a bit. Not saying the US is going to do it Japan, because it might continue to be the biggest, largest and most dominant stock market, but no one really knows. Where will the global stock market be in 30 or 40 years? I genuinely have no idea. Which is why I've sort of been alluding to, I mainly stick to global index funds and ETFs. There's nothing wrong with being all in on the S&P 500, but in my opinion, and from reviewing people's portfolios, being 100% in one country is riskier, because ultimately you're betting on one currency, one type of governance, and one economy. Not directly related to actual investments, but still part of the investment process, using a general investment account to invest. I see this quite commonly. For example, in Trading 212, the invest account is not a stocks and shares ISA. It's just a general investment account. Oh, and if you want to get a free fractional share from Trading 212, when you sign up, use the promo code MMS. Bang. By using the general investment account, you're exposing yourself to potential dividend tax down the line, potential capital gains tax down the line, which is all just unnecessary paperwork, and it's much better to shelter your investments in a stocks and shares ISA. Not understanding your risk tolerance and essentially having an aggressive portfolio, or I should say a portfolio that's too aggressive for your own risk tolerance. If you hate volatility, for example, then you probably shouldn't have a 100% equity portfolio. Why? Because there's simply more chance that you're going to panic sell, and that's something we want to avoid as long-term investors. Don't get me wrong though, if you have got decades of investing ahead of you, it will most likely work out better in your favor to take a riskier approach and be more into stocks compared to bonds. And that's what I'm talking about when I talk about your risk tolerance. It's really your split between stocks and bonds. This YouTube comment here really does summarize it brilliantly. And this person is a legend, had a bit of self-reflection and has adjusted their asset allocation to suit their risk tolerance. Of course, you can update those percentages over time, but now you've got a plan that you can stick to and you hopefully won't panic sell. It really is your percentage of stocks and bonds, your asset allocation that helps you stick to your plan and avoid panic selling, not just necessarily the actual investments you choose. Fees. Now, this is a very common one. You probably expected it to come up in this video, but I'm not just talking about high fees. I'm also talking about people not even understanding what fees they're paying. For example, if you invest into a fund, you will pay both an ongoing charge and a transaction fee. Most people don't know what the transaction fee of their index fund or ETF is. If it's an ETF, there'll then also be a bid-ask spread when investing. UK stocks incur stamp duty. US or overseas stocks or funds incur FX fees. Some platforms charge other types of fees like dividend reinvestment fees or regular investing fees, or even just straight up commissions to make a trade. You should know exactly what fees you are paying. Why? Ultimately because the less you pay in fees, the more that's compounded in your pocket over the long term. I'll flash an example up now on the screen, and this is a bit of an extreme example, but if you reduce your returns by 1%, as you can see, then over the long term, that is going to take thousands, potentially even tens, hundreds of thousands of pounds out of your pocket because those fees will be compounding against you. So not only should you aim to pay as low of a fee as possible, also know exactly what fees you're paying with whatever platforms, accounts, or investments you're using. 7 of the most biggest mistakes I see people make. So hopefully you're not making them in your own portfolio. And if you are, you can maybe go ahead, look into them and make any necessary changes. To be honest with you, I actually got a list of 10, 15 other mistakes. So I could make another video on this topic. So if you want to see that, just let me know. If you are new to investing, I'll link my free investing guide in the description. And if you want to see me roast other people's real life investment portfolios, then click the video on the screen. And yeah, sorry, Joe. You're also in that video, mate. My apologies.